So, hello everyone. Welcome to the December 2025 session of Macroeconomics Hours. Glad to see everybody joining us in person. And for those who are watching this recording on YouTube, we are happy to have you as members as well. Hopefully, those recordings are useful to you. So, we'll be talking today about some monetary policy issues and the recent developments and what's going on at the Fed. As you know, the Fed had decreased the interest rates, but it's been a bit more of a contentious decision compared to the decisions made in the past. And so we'll start with having Hadi talk a little more about the theory of monetary policy and interest rates. So Hadi, all yours.
Thank you. Let me, okay. Somehow, okay. Uh, Sorry, I'm not finding my slide. So I, where is this? Okay, now I got it. There we
Okay,
go.
great.
Share. Okay. So that this part is just the opening slide and then the discussion topic. Let me just mention that our the slides that we put online later on will have links to the background readings that we recommend you to take a look at, and in case you want to also read further. And, and now let me get to the issue that I want to discuss, and that's how does interest rate affect the economy? This is You're probably very familiar with all these, but I review them to provide a background for today's discussion. Largely, interest rate affects components of aggregate expenditure in the economy. That's where interest rate comes into real sector of the economy, the amount produced, the amount invested, etc. And there are four components, as you already probably know quite well: consumption, investment, government expenditure, and net exports. When interest rates go down, when the Fed or the central bank of an economy cuts the interest rate, it has some effect on consumption. Most people might think that interest rate, reducing interest rate will increase consumption, but that's not quite true. It's not clear that always that happens. It's a long story why there's that ambiguity, but I'm not going to go into details of that. If you prefer, think about that ambiguous as mostly positive, but not all the way. Consumption of durables, especially, may go up when interest rates are cut, but the effect on non-durables is more complicated. Now, investment most likely will increase because it becomes cheaper to borrow, cost of capital goes down, and therefore there's reason to more projects become viable as interest rates go down, cost of investment goes down. Government expenditure, generally no effect. Usually in macroeconomics, we assume that government expenditure is exogenous for the economy. It comes from out of political process, and therefore interest rates being high or low does not much affect the government expenditure. In some circumstances, that may be true that interest rate does have an effect on government expenditure, but generally we assume no effect because it's a political process that is largely exogenous to the macroeconomy. Then we have net exports, and that's it goes up when the interest rate goes down because currency depreciates. And when currency depreciation makes it more attractive for foreigners to buy domestic goods, and imports also go down because buying foreign goods becomes more expensive. So interest rate cut has a net effect of positive of increased investment, increased net exports, and that becomes additional income as the expenditure is occurs on domestic goods. Domestic goods producers can sell more, and therefore incomes go up, and then there are additional rounds of effects. But the main effect of interest rates cut comes to the economy through these mechanisms. Now, here, what I had done, I emphasized short run. Sorry, let me pick up a pen. Hmm. There's something strange here for me. All right. Very sorry about this. Okay. Hmm. I keep losing the window that I had opened. Okay. All right. I had emphasized here the short run, but long run, medium and long run, the effects may be different. For the medium and long run, we need to take into account the fact that the economy has a limited production capacity and aggregate demand. If aggregate demand is equal to production capacity, then the economy will be doing could be stable. But if aggregate demand goes up, then production is going to be stretched, and cost of production could go up, and that could give rise to higher prices and inflation. And if production capacity is bigger than aggregate demand, or aggregate demand is less than production capacity, there's some spare capacity, excess capacity, that causes prices to slow down or even fall at some point. So for the medium and long run, when the role of production capacity becomes very important, the limitations in capacity causes inflation to go up if demand goes up. And inflation will go down and prices may also go down if aggregate demand is too low compared to production capacity. That needs to be taken into account. So if an interest rate cut in this situation, it eventually tightens the market for inputs and labor and lowers unemployment rates, increase and rising aggregate demand increases capacity utilization, and this leads to higher costs and higher inflation in the medium and long run. In the short run, of course, we saw that there's an increase in output, but in the medium and long run, there may not be much of an increase in output beyond what the production capacity already gives us. Higher inflation rate when aggregate demand rises has these consequences. It has when aggregate demand rises and inflation goes up, then there's going to be small effects if the aggregate demand is less than production capacity. The negative effect that the aggregate demand being below production capacity tends to lower the impact of aggregate demand on inflation. As a result, if the aggregate demand is below production capacity and interest rates go up in that situation, there's going to be an increase in inflation, but it will be very small because the negative effect of weak demand pulls prices down or pulls inflation down. On the other hand, if aggregate demand is equal to or surpasses production capacity, then the effect is going to be positive and very strong. So inflation, there's some asymmetry in terms of how inflation behaves below when demand is below production capacity and when demand is above production capacity. Now, given the setting, then the question becomes what should be an interest rate policy and what does policy do to the economy in this situation. The Fed or the central bank in any economy does not have a direct measure of the exact size of production capacity. So they can't look at the demand and say that this is well above production capacity or below production capacity. Production capacity is a concept, not necessarily easily measurable. The way we assess it is by looking at some indirect measures that reflect the distance of production capacity and aggregate demand in the economy. For example, higher inflation indicates that we're going above production capacity, or if unemployment is high, it indicates that probably aggregate demand is below production capacity. Central banks use information about inflation, unemployment, GDP growth rate, etc., and also do some modeling to figure out where production capacity stands and try to use that information then to figure out whether we're below production capacity or above, and therefore set their policy accordingly. Now, because of the uncertainties associated with not knowing the exact size of production capacity, the Fed has to be cautious. And that's why they keep cutting, for example, interest rates in very small amounts, 0.25% every time they decide. Occasionally, they may cut it a bit more if they're more certain that they know where production capacity is, or when the distance between production capacity and aggregate demand is large. But right now, for example, the Fed knows that we're close to production capacity, but it's not sufficiently below production capacity that require a large cut in interest rates to push the economy forward. The economy continues to grow, even with the current interest rate, which is higher than what normally people expect it to be in the long run. And it's not just the current interest rate that affects the economy. Future expectations of future interest rates also matter a lot. If the Fed cuts the interest rate right now and people think that this is not sustainable and the central bank has to raise interest rates down the road again sharper, that also may affect their decision about investment or exports or even consumption. So that needs to be taken into account. The Fed in the US, for example, right now is considering what they might do next time they have a meeting in January. And it was very interesting that in the recent decision to cut interest rates 0.25%, they mentioned that probably next year there's going to be only one cut, not much more. And so that issue is very important for traders, for investors to take into account where they invest and how much they invest and how much they keep as cash. Basically, the portfolio that they want to hold is going to depend on what they're thinking, how they perceive where the Fed is going. The anticipated behavior of the central bank and its potential responses to macro trends or macro shocks play crucial roles in macroeconomic performance. Excessively low or high interest rates may undermine central banks' credibility on target inflation or expectation of deflation. So the Fed basically, the way the Fed behaves and makes policy creates a perception in the among the public of how things might develop. And people think about potential sources of shocks to the economy and form an idea where what the Fed is going to do and therefore where the interest rates are going to go. Okay, that's another topic, bubbles, that I'm going to discuss later. I'm going to stop here and leave it to Vlad to finish the discussion by mapping this into current situation, current
All right.
conditions.
Thanks very much, Hadi, and great to see more folks joining us. So let me share my screen if I can figure out how, and here it is. So to connect this to Hadi's discussion, if you take a look at the macroeconomics indicators update, and I'll ask everyone on this in this session to think to place themselves in the seat of Jerome Powell and to apply the principle of WWJPD, I guess. What would Jerome Powell do? Let's take a look at the indicators that they have. So first of all of those indicators, they are quite a bit delayed, and that's very much thanks to the government shutdown, which was rather extensive and where a lot of data was basically not collected or delayed in its collection, right? And so if you look at the unemployment rate, it's moving up, but moving up just a little bit. As of September of 25, which is the last set of data available to us, it was up 0.1% from the previous, this says May, it should have said from August. So this is only up 0.1%, right? So not a significant change. Labor force participation rate seems to be stable. It's not a major macroeconomic indicator, but I still, like to include it in those numbers, partially because of my longstanding concerns about labor force participation rate. Inflation, if you look at the CPI for all urban consumers, is up 0.1%. So it's up a little bit, which is consistent with the idea that the economy is still doing quite well and potentially operating very close to its production capacity. Of course, big chunk of the increase in August was in gas prices, and since then, energy prices stabilized a little bit. So we'll see how the numbers will come out sometime during next week. I think Tuesday, of this upcoming Tuesday, when data for October and November is going to be released, is going to be an interesting day to watch what happens in the markets. If you look at the core CPI, and as you recall what core CPI is, it's basically your inflation rate for consumers stripped of the impact of food and energy prices. And the reason why the Fed strips food and energy prices and likes to use that as its kind of like main measurement of inflation is that food and energy prices tend to be relatively unstable and they fluctuate a lot. And so excluding them from this baseline gives us a more stable measurement of what's happening in the economy. And so the performance there is actually pretty good from my perspective, right? We're certainly not at the 2% rate. That is what the Fed likes to see. We're still at 3%, but still it's down a little bit from August, right? Down by 0.1%. It's considerably down from its recent high of 6.6%, which was in September of 2022. And so I again apologize. Oh, oops, sorry. I apologize for something that I should have deleted here from this presentation. And let me try if I can do this right now because this is going to bother me. I should have taken this line out and let me reshare the screen. Um, so um, so the signs in here, and if you look at the GDP growth rate as of quarter three of 2025, it is estimated to be about 3.6%, which is not too bad at all. It was a little bit higher in the second quarter of 2025, and it actually was negative 0.6% in quarter one of 2025. But that negative number, by the way, had been driven much more by the increase in imports that took place in the first quarter of the year, because everybody was trying to import as much as they could, because they expected that the Trump tariffs would basically make imports more costly, right? And so let me ask you this. If you're looking at this table, and if you're Jerome Powell, one of the members of the Federal Open Market Committee voting in the December meeting, what would you do? Would you decide to increase the rate? Would you decide to keep the rate the same? Would you decide to decrease the rate? Anybody wants to volunteer and speak up? Tell us what you would do in this setting. Just unmute yourself and speak up and tell us your thoughts.
Well, I think it depends, right?
Uh-huh.
So if thinking about the 2% inflation target that like it used to be in the 80s,
Mm-hmm.
right? Then we are like twice as much, right? So why decreasing
Mm-hmm.
the interest rate? Right. On the other hand, like given the current state of US economy, like 4% GDP growth, half of it is AI related investments, might be like a bubble, not the real economy. So there are some worries, I would say.
All right. So how would Vitali vote in this case? What would you say?
I, I, I
Increase,
would not,
decrease rates, keep them the same?
I would keep
Keep
the
them the same.
same
Okay.
and
All right.
monitor what's going to
Anybody
happen.
anybody wants to argue a different viewpoint? Would you increase the rates or decrease the rates? Anybody else?
I have the same conclusion, Professor, to keep the rates, but
Mm-hmm.
I do have different reason. What expected for GDP growth rate is 2%, and in general, inflation is 2%. Now, all the data, inflation is a higher than expected growth rate than higher than expected. So I kind of think they subtract each other. That's why my uh, proposed conclusion is to keep the same rate.
Okay, excellent, excellent. So we can kind of see where we are going with this, right? Sort of basically, based on the theory, we can say that, well, we are probably fairly close to the production capacity because inflation is still very high. And the core inflation, sort of while going down a little bit, it's still very stubborn as it has to be, right? Sort of we've said this throughout the years, when we were running macroeconomic hours, that core inflation takes a long time to take down when it starts going up, right? And so, from this perspective, what we are seeing here is a decision that should be at least somewhat contentious, right? And this is exactly what took place in the Federal Reserve meeting. If you look at the Fed's, okay, I'm sorry about my typos. It should say December 2025 decision. I was terrible, I guess, in producing those. But if you look at, sort of what is happening and a very carefully calibrated statement, they're saying, well, look, economic activity had been expanding at a moderate rate. Job gains have slowed this year. Unemployment is higher. Inflation is higher from previous time in the year. It's a little elevated. So there is still considerable uncertainty about economic outlook. The committee needs to think about both sides of the mandate because they pull the committee in different directions. And basically, they were saying in here, look, sort of at this point, we're paying a little bit more attention to the employment part of the mandate and the downside risks to employment. And so, if that's the case, Then, sort of the committee decides to lower the target range for federal funds by 25 basis points. So now it's going to be 3.5% to 3.75%. But committee is also going to be a lot more careful in the future. And so, there is, of course, writing those statements is an art because everybody watching those statements, it's a little bit sometimes like reading the tea leaves or reading the coffee grounds, but the committee is concerned. And if you look at the composition of votes, so, sort of out of the 12 members of the committee, 9 are saying, yeah, let's take it down by 25 basis points by 0.25%. But at the very same time, there is one guy who wants to keep the target range as, sort of wants to lower the target range by 0.5 points, right? Sort of this is much more of an employment dove, I guess. And then at the very same time, a couple of guys, Austin Goolsbee and Jeffrey Schmidt, are saying, yeah, we shouldn't be changing rates. So these are the folks who are probably more of, inflation hawks, right, who are looking for that. And so something like this is really, really unusual, right? So there, in one of the articles at the Wall Street Journal that we shared with you, they contrasted the votes in the December of each of the last 5 years. You can see, and this is actually not just the Federal Open Markets Committee, right? But it's, sort of like everybody, sort of who is eligible to be on the committee. And I'll talk, very quickly about the committee's composition. But basically, you're seeing a lot of disagreement here, much less disagreement 1 year ago, and no disagreement at all in each of the previous years. So this is getting tough. Of course, there is also a very significant political component to all of this. As you know, President Trump, wants the interest rates to be lower. So that's probably something that's weighing on the officials quite a bit. We're expecting that there is going to be a new chair in 2026 once Jerome Powell's term going to run out. And so the dissent is significant. And, sort of as a reminder, basically, the Federal Open Markets Committee, FOMC, has 12 members. And basically, 7 of them come from the Federal Reserve's Board of Governors. The New York Fed president is always a vote on the Federal Open Markets Committee. And then the other 4 members are rotating members from 11 regional Fed presidents. And so this mix, those 4 members will change from time to time. And you can imagine that the economies in different Fed regions, they're not all performing at the very same time, right? If you're getting a member from a region of the Fed where economic growth is slower, you would imagine that they would be much more likely to vote for a lower interest rate in order to give a bit of the jolt to the economic activities. And so what we're seeing is some very interesting standoffs between inflation hawks and employment doves. We also have relatively little data to go by, right? Because, obviously the Fed has access to more data from their own projections compared to us, peasants who are looking at the numbers from September of 2025, right? For everybody else, sort of, and, from this perspective, you also want to potentially find other reasons to support your decision. And one of those reasons actually came from Jerome Powell. He said, well, look, sort of we're concerned about employment more than anything else right now compared to inflation. Inflation is not as much as a concern. And one of the reasons why this is the case is that there is a potential concern that the job creation is overestimated by up to 60,000 jobs per month. And this is a very, very high number. So where is this concern coming from? Well, sort of the folks who are counting employment numbers, this is your Bureau of Labor Statistics. And so in some cases, they have to make educated guesses what happens. And those educated guesses come at the point where it's difficult to get a business to fill out a form that basically reports to the Bureau of Labor Statistics of what is going on, which means, sort of it's either an employer that shut their doors because, simply said, there is nobody to fill out that survey, or it's the businesses that opened their doors because they haven't gotten onto the radar of the BLS folks and so they might not necessarily get the survey. So BLS is kind of formed to make educated guesses about what is happening in those newly created and newly shut down businesses. And so this is what we call the birth death model at the BLS. So this model is going to be revised. And so hopefully the new methodology that comes online about 3 months from now in February of 2026, or 2 months from now, I guess, should be a little more reliable, though still questionable, because as you can imagine, this is a difficult set of data points to collect. So even if the model improved, it's not going to be a terribly wonderful, terribly highly reliable model, but hopefully should be better than what we have right now. And that's what Powell points out to as one of his main concerns about employment numbers. And for me, I'm not really sure whether I'm necessarily buying this argument terribly much, right? To me, it's almost a bit of a case to save your face and to explain why sort of the vote came sort of towards decreasing the interest rates, even though the economic performance is still basically mixed, right? So that's essentially the concern. But as I said, Tuesday, December 16th is going to be a fun day for those of us watching those numbers. The October, November employment data are going to be released. The inflation numbers are going to be released pretty quickly too. So we'll get more data and we can get a sense of where the economy is. So, actually, if you look at how significant this 60K revision is, this 60,000, potentially 60,000 less jobs in the businesses at the birth and death stage, it can flip the numbers wildly, right? Because in May, the economic growth was about 20,000, right? It could push it down to negative 40,000. In June, it was a little negative. This could make it a lot negative, right? So those numbers are not looking great. Sort of the September seems to be a little bit more of a bright spot because employment, so hiring was significant in there, but it could be moderated by basically nearly a half, right? So that's a challenge. And so that's what we have right now. And I can see Vitaly is making a comment that they certainly are concerned and they should be concerned about the accuracy of BLS statistics, which often goes through the revision process. And sort of the BLS had been fired recently by President Trump for exactly this issue, right? Which of course we view as more of a political action rather than an action based on economic fundamentals. But the criticism there certainly is quite reasonable, right? And so in thinking about whether they should really be worried quite as much about job losses, one of the articles we shared with you was an article from The Economist from the end of November that is called "Why Worries About American Job Losses Are Overstated." And this kind of tells you right away what the Economist's answer is. They're saying, no, they shouldn't be worried too much. And so some of the explanations they provide is that wages actually are higher than they have been in the past. If you look at the wages for lowest earners, they increased by about 19% in real terms since 2015. So folks who have not been making much money have gotten quite a bit of the raise. Inflation is still elevated, right? Which is a sign that the economy is overheated, that it's operating close to its production capacity. Increasing and decreasing the interest rates can actually contribute to inflation, right? Unemployment rate, if you look at the unemployment rate over the past 10 years, it's been pretty low compared to historical standards. And if you look at some of the explanation of why this is the case, and especially why even our estimate of this, equilibrium rate of unemployment, or the non-accelerating inflation rate of unemployment, or the natural rate of unemployment. So there is multiple, names for this phenomenon, for this concept in the economics profession. So the explanations there's actually quite a few, right? So one of the explanations why your non-inflation accelerating rate of unemployment is lower is that the labor market matching is better due to better information, due to better technology, right? So we've obviously come a long way from workers having to flip through the job ads in the Sunday edition of the newspaper. A lot of information is online, which means that it's easier to apply for jobs that match your skills, which means that the frictional unemployment is lower, and workers stay unemployed for shorter periods of time between new jobs, where they get new jobs to improve their labor market outcomes. We can make an argument that overall the workforce human capital is improved. Our workforce is more educated. In addition to formal higher education, we've seen an explosion of human capital training programs through short-term training, like the coding academies. And so from this perspective, we are seeing better human capital, which leads to better economic growth. We are seeing also more flexibility in labor markets. And sort of this is actually an interesting and nuanced argument, but basically what it says is that if you look at the economy now, the labor union membership is at the lowest that it's been in decades, right? Sort of it's relatively low, even despite the Biden's administration efforts to increase labor union membership. And what that means to us is, that the wages in response to negative developments in any given industry, they're actually much more flexible. Compared to the labor unions, where labor contracts only allow for escalating wages, even if the company is not doing well and the economy is not doing well, right? And sort of there is better flexibility due to that. We also can see that in many states over time, inflation has taken out a bite of unemployment benefits. And those unemployment benefits have not been necessarily revised to reflect higher prices. And so if you have less generous unemployment benefits, that's a lower incentive for people to stay unemployed for longer and say, hey, I quit my job, or I was fired recently. I'm going to stay and collect unemployment benefits for 6 months or for however long I'm able to collect them, because there's simply not much to live on, right? And sort of from this perspective, you can kind of see like that. Obviously, from a worker's perspective, that could be a negative thing. From the economic perspective, that means that the labor market adjustments could happen quite faster, because there is an incentive for you to find a new job faster, right? Sort of that is real. So there's also more flexible work arrangements, right? If you look at the work arrangements we have right now, a lot of people could be working from home, right? And if you're working from home, perhaps you'd be much more amenable to take, to not to demand a higher, sort of increase in wages. There is a lot of people who work on contracts, who work as independent contractors. And if you look at the gig economy, that's basically pretty much it. And if you look at the overall division of labor, so we kind of know that compared to, say, 30 or 50 years ago, or even 15 years ago, service sector is growing in its importance in the economy, right? And for unemployed workers, it's much easier for somebody to move from one job in the service sector to another job in the service sector, as opposed to losing a job in manufacturing and having to go to a sector that demands a wholly different set of skills, right? Of course, the negative part here is that the service sectors typically, often rather than typically, pay less, but that's a different discussion, right? And so from this perspective, sort of like, why do you even want to cut rates if things are going well? Well, if you look at the macroeconomic variables, job openings and unemployments are increasing. You want to avoid having this happen, sort of for an extended period of time, because what it will do is that it will create a downward spiral, which will be very difficult to address. And the response to this argument that economists offer is that, look, if you look at the historical standards, we are really doing very, very well, right? So unemployment is still very low compared to historical, and so that's a good thing. We're seeing in the last year more large companies shedding workers. Well, that's true, but those companies also have been hiring a lot of workers and potentially overhiring since the pandemic. And other companies are still hiring pretty well. You look at the September job reports, 120,000 new jobs. This is pretty respectable, even if it's one half of that. That is respectable still, right? And the claims for jobless benefits, which is kind of your real-time signal, because this gets published weekly, I want to say, and Hadi, correct me if I'm wrong, but I think these are weekly reports if I'm correct. But if you track the jobless benefits, the new claims and the, sort of basically tend to be very low by historical standards. And then the final argument for cutting rates might be, well, but look at the consumer confidence. The consumer confidence, if you look at the surveys of consumer confidence, is very, very low. But what consumers say and what consumers do could be different, which is the argument, well, you might not be feeling great about the economy, but you still keep spending as a consumer, right? And so that's the counter argument to something like this. So from this perspective, there might actually be a better explanation for weaker data. First of all, the economist says there is no imminent reason for expecting economy to collapse. There is nothing on the horizon that potentially can give us a significant push towards, the down direction. Sort of that's one of those things. There is a much better explanation for this, including for consumer confidence, which is what economists refers to as the Trumpian uncertainty. And this is true. The president's actions have been let's call them a lot less predictable, for example, than actions of presidents in previous administrations. And so something like that could be a drag on both company and consumer confidence. But overall, what we are seeing is the economy in the US seems to be this, seems to continue to be this little engine that continues performing well over the years. And there is really no big reason for us to expect that this is going to change in some way. And so with that, I'll stop sharing my screen and I'll take any of the questions that may have been in the chat. Or so if you ask something in the chat, or if you want to ask somebody, please unmute yourself and speak up. We'd love to have a conversation with you about those issues. Vitaly, go ahead.
Yeah, I wonder what's your stance for the target inflation. Should it be 2% like in the 80s? Many people challenge that even then, right? Like, why 2%? Why not 3%? So what do you think?
Yeah, I think 2% is absolutely a reasonable target, right? So I think it's interesting that there have been revisions in the targets. So a few years ago, the Fed actually, because the Fed, and this is an interesting nuanced discussion, the Fed's target was saying that we are willing to tolerate a maximum unemployment of 2%, right? And then a few years ago, I want to say in 2020, and Hadi again, correct me if I'm wrong, the Fed actually changed this target from a maximum of 2% to an average of 2%, right? Which suggests that Fed was willing to tolerate higher inflation rates. As long as they kind of like averaged, sort of it's okay for you to have 3% in one year if the previous year you had 1%, because the average is still 2%. And interestingly, so sort of we've had this Macroeconomics Hours seminar. We've ran it with Hadi for good, I want to say 6 years, 7 years, well, close to 6 years, right? And sort of one of the things that both of us said is that we are really troubled by this, right? Because basically inflation, once it gets started and once it enters this spiral, right? Downward spiral, it's going to be very hard to control. Sort of from my personal experience, I've lived through significant periods of inflation and hyperinflation in the former Soviet Union, right? And so perhaps that, sort of certainly influences, sort of my take on that. But my first reaction to that Fed pronouncements that it was a hot mess. And then, sort of recently Fed kind of revised that policy quietly and said, oh no, we're still going to be targeting the maximum inflation rate of 2%. So I think from that perspective, it's a good take. Okay, so what was the question again? So because I think I started answering that and then I went somewhere else.
No. I got the answer. The question was like this Paul Volcker's kind of target of 2%, right? And many people were objecting, but Paul Volcker took the economy from like double-digit inflation, right, and brought it to like 2%. And there were many people like going crazy, right? Like farmers were bringing huge like canisters of milk and just pouring it in front of like his building, right? But he did it. So
Yeah, it was tough, right? It was exceptionally tough. And there was actually a lot of criticism of the Fed because essentially what they did is that they certainly brought the inflation down considerably in the 80s, right? But that came at a cost of much higher unemployment, right? So it was a very, very hard landing. And so one of the things that everybody was rooting for Fed to do, and I personally think that Fed largely accomplished that, it took us from a period of relatively high inflation, which again, many of us view that as Fed had been very late on acting to this inflation, but it still eventually took it down and took it down in a respectable way and achieved a soft landing without a major increase in unemployment or a major decrease in economic growth. And so that was pretty good. But sort of my sense is that sort of I don't know if because my expectation is that the inflation will remain elevated for quite a bit longer. Sort of, I don't think that they're going to take it down to 2% in 1 year or a couple of years, especially if they're looking at the core CPI numbers. It will take us a while to get there, but over time, maybe the target will get revised, right? Because there is a lot of other pressures on the economy. We're dealing with the impact of a very, very significant amount of government debt. And so, 2%, might no longer be, the target going forward because it wouldn't be achievable, but it might get taken up to something like 2.5% or 2.8% or, something a little bit under 3%. But I think it's probably not going to be by choice, but rather, sort of being forced to do something like this. Hadi, what's your take on the target?
I believe that they should go back to 2%, and it seems that they've done that.
Mm-hmm.
And the problem is this, that if because of what has happened in the past few years, we change the target, raise the target to 3%, it's
Mm-hmm.
not going to stop there. Then they're going to say, but why not 4%? Why not 5%?
Mm-hmm.
And the mistake that the Fed made in coming up with that average rate being about 2% and a bit higher, a bit lower, that's fine, as long as it fluctuates. It was a flawed logic, because the problem is that if inflation suddenly jumps to 5% in 1 year, as it did go to 9% in 2022, then what is the Fed going to do in the following years? It has to actually make inflation negative to get the aggregate equal to 2%. And
Mm-hmm.
it was just a stupid idea. I
Yeah.
don't think they should have let the inflation as loose as they got, as risen as it got. So it's very important, I think, that we keep the 2%. It's for credibility of the Fed is important, and for the credibility of what's going to happen in the next few years. It's very important that people continue to believe that the Fed has a serious target and it's not going to change it just because last few years inflation rate has been high.
Mm-hmm. Yeah. Yeah.
By the way,
Absolutely.
just adding one little thought, it's very important that they don't define this as maximum inflation, as the target inflation, because
Mm-hmm.
if it falls below 2%, they should do something about it and raise it back to 2%.
Mm-hmm. Yeah. Thank you. Folks, so Vivian, can you voice out your question about no reason to worry?
Well, I'm sorry. Yeah, I mean, there's so much spending on AI and even raising debt, billions and billions, hundreds of billions. And then whenever you see a lot of debt in the system, then that's kind of sign to worry about it. So I don't know. I'm not so sure exactly where the economy is at this moment, and I don't know why everybody's spending like there's no tomorrow. And then also the employment rates is also kind of funny. We haven't really figured out about the employment makeup right now, because there's a lot of immigration policy that chase out people and limiting people to come. And I'm just very confused, honestly. I don't
Mhm.
know.
Yeah, and Vitali is also making an argument that this is, somewhat similar to the dot-com boom in the late 1990s, early 2000, which led to a very significant crash. And I think from that perspective, that's probably a concern, right? At the very same time, sort of this pattern is not an atypical pattern in my opinion, right? Sort of generally, what you see when a new general purpose technology comes in, you kind of expect to see a lot of enthusiasm, a good amount of overspending by businesses, potentially a dip in employment productivity as firms are channeling their resources into adopting new technologies and sort of figuring out how to use them in the best way. And sort of if they do things well, then the contribution to productivity will become higher in the future, right? This is the J curve theory of of how the introduction of general purpose technology works, right? But that's going to be only true for some of the firms, right? Sort of some of the firms who've made unreasonable bets, who sort of overspent on the new technology but took the same in a different direction, they probably will be destroyed, or they will do very poorly. But sort of there is of course potential for the AI bubble. It might not be as widespread as the dot-com boom, right? And it might be concentrated in few very large companies that also so their valuation increased by multiples over the last 5 years since COVID started. So there is, sort of course, some fear of what will happen to the asset markets, to the stock markets as a result of that, right? And the fear is that it might give it this initial push to the market, and the markets could come tumbling down. So that is certainly still a concern for me.
Yeah, well, to me, it's really important because, as I just wrote in the chat, the dot-com bubble and its burst led to zero interest rates to kind of
Mm-hmm.
save the economy. That led to low interest rate, like variable mortgage rates, which
Mm-hmm.
saw the seeds for like irresponsible like mortgage borrowers, right?
Mm-hmm.
And it led to 2008 like derivative and everything crisis. And the government had to react with like zero interest, a quantitative easing, and then zero interest rates for a few more years. And then like maybe by 2010, it was like a good time to recover. And then COVID hit, right? So it's like a never-ending story with like printing money and printing money and printing money. And if we see another bubble right now, well, we saw how it happened like 25 years ago. Aren't we
Mm-hmm.
afraid of like we printed so much money? The
Mm-hmm.
like 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 I think the volume of money is now like what four times larger than before 2008, right? Dollar is losing its positions as the currency, like global currency and reserve currency. Even the head of European Central Bank said that, well, we will be reducing like the dollar reserves, right? There is a trade between China and Saudis in yuans, right? China and Russia in rubles. So, like, isn't it like a
So I
warning
think,
sign?
those are all good arguments, right? And those are, sort of good, sort of hypothetical directions in which we could see some of the roots of the crisis. But generally speaking, and we talked about this in the past. So from my perspective, like the worry about the loss of dominance of the US dollar is probably overstated, because we've seen, because the dollar is, sort of generally speaking, if you look at the at the currency transactions, right, at the exchange transaction, the dollar is still and it's been a while since I looked at those statistics, but I think the last time I looked at the statistics, dollar was one of the parties in about 88% of those transactions, right? It used to be above 90%, but despite everything that Russia had done, everything that China had done trying to move their partners towards sort of using their currency to trade, there has actually not been very much progress, right? So the dollar still retains its status as the world's reserve currency. and the Fed still kind of retains the status as the world central banker, even though the Fed keeps saying that no, that's not what we want to be, right? But I think it's still the reality of things. So yes, there are things in there, right? So Larry is saying, well, maybe we should consider going back to the gold standard. I think that would be probably a huge mistake for us, right? I don't want to necessarily get into the discussion of gold standard, but the gold standard probably contributed to a lot more worldwide instability than sort of the fiat currency regimes have, in my opinion, right? We've sort of that was sort of a policy that deserved to be taken down, and we should let the markets determine the value of our currency rather than some arbitrary standard, right? But still, sort of, from my perspective, potentially AI bubble to me is not necessarily as much of the concern as the dot-com stocks boom back in late 1990s, early 2000s, because it is, I believe, kind of isolated to just a subsector of the company rather than being, subsector of economy, subsector of high-tech companies, rather than something that impacts one emerging, part of the market, I guess. But I might very well be wrong here, right?
Vlad,
Hadi?
I'm sorry, Vlad, I kind of like not very have a lot of hope or
Mm-hmm,
expectation or confidence in US dollars. I know that now is still is probably the go-to currency still, but
mm-hmm.
a lot of governments have started to diversify and hold other currencies. I think this is a trend that's not gonna go back
Mm-hmm.
unless the US is gonna change and go back to have a little bit more of the
Oh,
competence of
I
people.
agree with you. I agree with you 100%, right? I think my argument is basically, saying is that, sort of should we expect to see, sort of the percentage of hard currency transactions that include dollar to continue going down? Probably yes. But I think, sort of if you look at the overall volume of transactions, even if those decreases over the years, the dollar will still maintain its dominance. And if the Fed is successful in fixing its reputation as the inflation fighter, um, which had been, quite affected by its failure to control inflation when COVID started, right? So the dollar will still remain its dominating position, though it's not going to be as dominant as it used to be.
That's hope. There's always
Yes.
hope, and hope is cheap.
Okay,
Well, it's
maybe
cheap and
another
eternal, right?
maybe another hard question by the end, right? So you see US like how much it owes, it grows and grows, and it's kind
Mm-hmm.
of um, it's just to show that, hey, there is a ceiling because ceiling is always raised, and even Trump overpromised like how much the deficit will be reduced, and then as soon as Musk tried to do it, we heard so much screaming from like everywhere, and then Trump like had the largest budget deficit in the history, right? So it's growing, and it seems like obvious, oh, let's reduce the spending and let's increase the kind of tax income for the government, etc. Right? But we saw in like decreasing the spending, it's very hard, right? As in the Musk example, right? And Ray Dalio argues in the Changing World Order book that, hey, nobody was able to pull it off in the history, no politician, right? So,
Mm-hmm.
and then it's growing. And then also as a reserve currency, there is a lot of inertia. And again,
Mm-hmm.
from the very same book, Ray Dalio argues that, well, it goes on by like inertia, and then suddenly everybody realizes that there is no value, like backing that paper, right? And then it might start going down really fast, right? So, what would you suggest as like a viable approach to reverse the trend of like growing countries kind of how much it owes
Yeah,
indefinitely?
this is a large and loaded question, right? So I think we might
I
want to
know.
come back to this in the future sessions. But I think you're right. Sort of in a sense of, sort of the very significant deficits that we're seeing, that's that's potentially a huge concern, right? This is a very significant concern. And United States is operating, sort of at the point where it still has significant amount of fiscal space, that is significant amount of power to borrow relatively cheaply, but there are cracks in that fiscal space that are showing up, right? And so, sort of, I think, sort of, there is probably about no more than 10 to 20 years for us to fix this trajectory and to become more fiscally responsible. And if we don't, fix things, then, there could be potential for very, very significant downward adjustments that will hit all of us very hard. And hopefully what we'll see in politics is more emphasis on, sort of people understanding how it works and electing a few more deficit watching government members to offices, right? Both to the legislature and to the, executive branch, where we can do better in terms of our borrowing, right? But I think this is absolutely a point where a lot of danger is coming from. There is no doubt about that.
Before we locked off, but you have to come to the Bay Area. This is a lot of Bay Area people here.
Yeah, I think they're very, everybody here is in the Bay Area, right? So, so they'll have to do, they'll have to do better in attracting folks from the rest of the country too. But
We don't really worry about that. We would like you to come to the Bay Area for sure.
yeah. All right, good deal. So I'll have to visit with Hadi sometime soon, and so we could do
Yeah.
we could do a local meetup, right?
Yes, please.
Uh-huh.
We are happy to come as well. We showed that during iConverge.
Yes. You guys have been represented in force. Was very excited to see so many folks from the Bay Area joining.
And thanks a lot for having these meetings.
Yeah,
It's
always.
highly important, like to stay in touch and to stay informed and to hear your opinions, professor. So thanks a
Well,
lot.
thanks
you so
very much for joining us, folks. Any ideas for future meetings? Anything you'd suggest we cover? I mean, certainly we can come back to the topic of government deficits and see how the Trump administration is doing compared to the Biden administration, and how the fiscal space is continuing to shape up or shape down. Anything else? Any other thoughts?
Well, that'll be
Yeah.
a great one. I like that one. And
Yeah.
also
Yeah.
the employment over manpower, whatever that the country has right now. I think that is a very strong indication where the economy is gonna go.
So trends from labor economics, basically.
Right.
Okay. All right.
Yeah.
So yeah,
Well,
I'm thinking also might be a good idea to talk more about to talk about social security, or sort of like the old age social net systems in the United States and worldwide. That's another topic for me that we haven't talked about for a little while, right?
That's what I'm about to say, mention about the Social Security funds that might get dried up by
Disappear,
2035 or
right.
something.
Yeah.
Mhm.
Right.
And
That's a very important question. The structure population is changing, and that could have major consequences for Social Security and pension funds.
the 401k is also like kind of dissipated with so much of money being allocated in funds that are not getting getting enough returns on it.
Okay. Well, yeah. Yeah, 401ks and the sort of the rise in automated investment, right? Which actually, this is a part that worries me somewhat, right? Because the index-based investment, I think there is probably going to be some sort of an adjustment in the future related to that, but we'll see how it works out. And of course, we were planning to talk about the asset bubbles if we had time. We kind of ran out of time, so we'll have to pick up the asset bubbles discussion sometime in the future. But So, thanks guys for lots of good ideas. We appreciate it.
So
And
along the lines of the social security, like what other countries, I know in India has the provident fund that is being from the government of India.
uh-huh.
So like if you can give us some insights into like what would be the typical uh, the security net that government offer and the private offer like 401k and
Hmm.
social security funds plus Medicare, Medicaid. These are all the
Hmm.
social security net for US citizens.
Okay.
But are
All right.
there other countries like UK? I think they have something public. Canada, UK and Canada, they have a public healthcare system,
Yeah. Or,
NHS.
of course, China, right? Sort of China is also an interesting example, especially because of their system of the equivalent of social security, and the fact that there is less than sort of like, despite the major reform that took place about what, 12, 14 years ago, there's still less than 60% of their people that are covered by the national social security system. Okay, yeah, that sounds like these are sounding like very fun topics.
Yes.
Yeah.
Like,
And the
Very
closer
good.
look,
and not, I'm not a mole from CMU.
no, you're joking. You're joking, and
I know.
we love you. Just making jokes. And professors, yeah, closer look into AI bubble with like
Uh-huh.
industries, economic segments involved, like how much was spent, who is spending, who is accumulating the debt, the amount of private debt raised,
Hmm.
right? How much money companies, I mean, OpenAI, Perplexity, all those AI companies, how much money should they be making to be able to kind of pay back or like somehow make those investments and debt
Uh-huh.
levels justified? Because it seems like there is a big gap. And I agree with you completely that it's a worthy technology and it's worth investing, and bubbles are happening, and then there is a leapfrog, right? Like with dot-com bubble, right? We saw companies like Google and Amazon going out of the
Hmm.
bubble, obviously very worthy, but also economically, it was quite disastrous for many people involved and economically, and there are like still I think we're still seeing ripple effects from that dot-com bubble, right? So what's going to happen here, including major investments into data centers,
Uh-huh.
land, power, right? Resurrecting nuclear powers that were closed,
Hmm.
resurrecting them back, thinking about building new ones, right? So all of that would be really interesting to have an expert view on that.
Okay.
Yeah, but the
All right. So they'll
problem,
have to probably find
The,
some. I'm sorry, Hadi, I keep interrupting you. Go ahead.
the,
there is like the who is like like there's very old game like if you go to Marrakesh, the town center or any other old places, they have this game called like they have a small like like a card game, and then they keep shuffling, and then like they make a bet on some money, and if it turns out they bet on the right image or something, like they win. So that's exactly the way currently is like who is holding the money? Like is OpenAI holding money or data centers holding money, or is it the service cloud service providers holding money,
Hmm.
or the consumers holding money? Like it's like going round and round and round, and then not knowing who is holding the money. Like it's just quick pass around from
Okay.
across.
All right. Well, Bill, thanks for that suggestion. Hadi, go ahead.
I just wanted to point out the last article in the list that I had, and you probably posted them on uh,
I have.
LinkedIn. And,
Hmm.
right, there's an article from this week's Economist about bubbles and how they burst and how you can predict them. And it's very, very interesting article. It makes the point that it's essentially almost impossible to predict the burst of a bubble.
Hmm.
And people who have betted on this, big names in finance, they've tried to predict within a year or so when something like that happens, and they've lost big money and closed down. one example is the guy who had predicted what happened in 2008, 2009. And he then, after that, created a fund to bet on the decline of the market. And he closed down his fund recently because he lost a lot betting against AI.
That's
But
right. So making those predictions in macroeconomics, it's a very difficult business when you're talking about short term, about something. It's really hard. I mean, you could spot the trend, right? And the trend may very well play out over the long run, meaning over 10, 15, 20 years. But to say that something is going to happen next year, boy, there is not a great track record of those sorts of things, right? And
right,
what you also see is that folks who are successful in making those short-term predictions. The data suggests and the experience suggests is that very often this seems to be a result of a, kind of like a random walk sort of event, right? You get lucky enough to predict something, but if you are continuing to predict the, different movements in the short run, you're not going to do quite well in something like
right,
that. So yes, predictions is an unthankful business.
Right, but you see, I think there is a huge difference between like saying with high degree of certainty that, hey, it's gonna burst, and another
Uh-huh.
thing is like when.
right,
So I agree
Mhm.
exactly.
completely. When is like a hard question nobody
Exactly.
can predict.
That article that I mentioned has two very nice, interesting charts. Looks at the predictions based on CAPE, the uh, seasonally adjusted, not seasonally, cycle adjusted price earning ratio, called
Mhm.
CAPE. Based on that, and so on the horizontal axis, they have the CAPE measure, and in the vertical axis, they have returns after 1 year, and then another one says it returns after 10 years. And
Mhm.
CAPE predicts after 10 years very well, very close. The higher the CAPE is, the bigger the
Mhm.
fall or the less growth in the stock. But
Mhm.
1 year is just mixed. There's no way
Mhm.
you can predict in 1 year. So the AI is probably, in all likelihood, there's a bubble right now. But
Mhm.
we can't say whether this is going to happen in 1 year or 5 years. But for sure, 10 years from now, it's not going to be a very attractive investment.
Mhm.
But then the one faces the dilemma that knowing this, what are you going to do? So you have to buy the stock right now or invest in AI for now and hope that next couple of years nothing bad happens. But then at some point between now and 10 years from now, you have to get out.
Yeah, but what if it's like in 3 months, not 2 years, right? And then when it
Exactly.
starts crashing, you might miss the
Mhm.
moment and it will be too
Exactly.
late. For instance, I was talking with someone who lived through the dot-com bubble and they made nice money, etc. But he said that him and his friend, the only one who retained their wealth, they were bringing all the money they made to the bank while all their friends were investing into stocks like dot-com stocks. So everybody else, they say, lost everything and they've still kept nice amount of money. So,
Well, just avoid taking too much risk. Either
right,
way.
right. So, like predicting exactly when things go, like the world is going to an end, but before it happens, we can make a nice amount of money. Like, well, maybe.
Mhm.
Maybe.
All right. Well, folks,
If you're lucky.
I lived through the dot-com burst. Actually, I was in the midst of the dot-com burst that happened back in. I was with the company called WebMD, like it's a web all dot com, and so like a lot of companies being laying off left, right, and center back in 2000. Yeah, so that was the first time I got laid off, and then quickly got moved to another part of the company. And so I got immune to the layoffs after that. Like it happened, okay, good. So I got laid off. Layoff came at Mastercard. Good. I got a package. I went on to start my own thing, and then like got funding. So it's all part of the game. Like, but I don't think like what Professor Vlad said. This time around, it's different from the dot-com burst. AI, it won't be that much of impact as we saw in the dot-com.
Right. I think the parallels with .com is a bit overstated.
Yeah.
This is a different problem. And every time the market crashes because of a different reason that nobody has thought about.
Yeah.
Yeah.
Yes. So the sort of the every crisis is unique, right? This is something that we've seen. I don't think there has been a single crisis over the last century that kind of played through the previous crisis playbook.
Exactly. Previous crisis, everybody knows, and there are safeguards against that kind of crash. But there's always another angle at which some shock is going to come to the market and going to crash it.
But Warren Buffett stayed away from dot-com investments. He was criticized heavily for that, like, hey, you're old, you don't understand it. And then it crashed, and he was like a nice guy after that, right? So yes, reasons might be different, but also there are some fundamental like concepts, right, that can be applied, and you can say like, hey, yeah, I'm out of it, right? For instance, right? Or no, I want to play the game. If it crashes, it crashes, right? Right. So to me, yes, there are different variations, but also there are fundamentals. I guess this is what you guys are teaching us as well, right?
All right. Well, folks,
Yeah, thank you so much.
we've had a fantastic discussion, so thanks very much for joining us. We'll stop the recording in a couple of seconds, but hope to see you in future sessions. I'll post the recording on the YouTube as soon as I'm finished converting the video, and continue giving us idea for next sessions, and tell your friends. All right. Thanks all, and talk to you soon. Happy holidays and Merry Christmas.
Merry Christmas.